Welcome back to the channel, everyone. For those of you who don't know, my name's Connor and I'll be your host for today's video. By popular demand, we're back today with another superannuation video, and this one's going to be good. Today, we're going on a deep dive into the world of super, and we're going to be exploring the different investment options that you have available to you right now. Now, unlike other videos I've seen on the topic, we're not only going to be talking about the different places you're able to invest your money within super, but instead, we're going to review a real super fund so you can see firsthand exactly what options are available to you. And this will not only give you the tools so you can evaluate options for yourselves, but it'll also show you exactly what you need to be looking for. We'll also be going through the exact steps you need to take in order to change what your super is invested in. Because chances are, after learning just how many options there are available to you, you'll want to know how to change it, just in case. Now, if any of you are sitting there going, what is this guy talking about? Or you're still quite new to super and you don't exactly understand how it works, I actually posted a video just last week where I explained the first few steps you need to take in order to take control of your super. So either click the link here or the one in the description, that'll bring you up to speed, and then come back and watch this video. And one last thing before we jump on the computer and go through today's topic, I'd just like to thank today's video sponsor, which is smashing the like button. Now, I know for any of you who watch Graham Stephan know I stole that straight out of his repertoire, but seriously, if you guys wouldn't mind just going down and gently tapping the like button, it actually really does help us out and it helps push our content to a larger audience. So if you could just take a few seconds to do that, we would really appreciate it. Okay, so now that that's out of the way, let's jump into it. Okay, so we're now on the computer, we're looking at our example super fund, which is actually my super fund, UniSuper. So most super funds will have a website similar to this, where they outline all of their different options. And so to look at specifically where you can invest your money with this particular super fund, you're looking for something that says investment, then we can go down into our investment options. And this is where the fun begins. Now, just before we go into the specific options offered by UniSuper, I think it's important to note here that at pretty much every single super fund and within every investment option they offer, you'll find that they usually give some sort of indication of the risk and then the return of their options. And each option will have varying levels of risk and a different estimated return. Now, it's important to keep in mind with return specifically, like they say on the super ads all the time, past performance is not an indicator of future performance. And basically what this is saying is the returns you see on the websites are just estimates based on the previous return those particular investment options have generated. And just because those returns were made in the past, it doesn't mean they're necessarily going to make those into the future. Now, with that being said, there are three main investment options that most super funds offer that accommodate for different levels of risk and return. These are conservative, or sometimes called defensive, then there's the balanced option, and then there's the growth option. And the general distinction between each of these is their risk and return. Generally, a conservative option will provide less risk, but then less return. The balanced option will provide slightly more risk and slightly more return, and then the growth option, the higher risk and the higher return. Now, with that being said, none of these options are completely without risk, and none of them can guarantee any of these returns. But inside of each of these options, there are different assets that typically will fluctuate more in the high risk category versus not really fluctuate too much and have more security in the low risk options. So with that in mind, let's have a look at what UniSuper has to offer. So when we scroll down, you'll see they've broken their investment options into two main categories, pre-mixed and then sector. So the pre-mixed ones are the ones that we just spoke about, ones which will have a general risk target or return target and is essentially put together by the professionals, by the super fund themselves. So you can see, as we were just talking about, here's the conservative option, they've got the balanced option, and then they've got the growth option. Now with UniSuper, they also offer a conservative balanced. So that would be sort of midway between the conservative and the balanced option. And you can see that with the returns being slightly more, or estimated returns being slightly more in this case. But then on the higher risk end, they also have high growth, sustainable high growth, and then sustainable balanced, giving you a variety of pre-mixed investment options depending on how much risk you can tolerate and what your expected return is. So we've established that a conservative option is lower risk but lower return. So what does that actually look like? So if we go into the conservative pre-mixed portfolio here on UniSuper's website and scroll down a little bit, you'll see here they give an indication of their portfolio's performance in terms of a percentage per year. They also compare that to a super ratings median performance for this particular fund. If you go further down, you can see over the long run, the last 10 years, they've actually outperformed the super ratings median performance. So that's something to have a look at. Now this just gives you a more visual representation of how the performance would be. Now this is what a lot of people are interested. This is the breakdown of the different assets. So as you can see here, the overwhelming majority of the holdings as part of this pre-mixed option is in cash and fixed interest. So we can explore in a little bit more detail what that actually means. But when you see cash or fixed interest, those are safer investments, if you can say that. Definitely compared to shares, they would be considered more reliable, but much lower return for your investment. But you can see they're not 100% in cash and fixed interest. They do also have a little bit of Australian shares, international shares, property and infrastructure and private equity. Now, if you scroll down a little bit further, they actually give you details as to what you actually own as part of these three asset classes here. So you can see for Australian shares, they own the ASX, the actual company. They've also got Woolworths and Commonwealth and so on. Then for international shares, they've got in the US, JP Morgan, they've got Bank of America, Apple, Microsoft. I also saw down here, Samsung. So they own quite a few companies from across the globe. And then as part of their property, you can see they own quite a few buildings around Australia. So we'll just quickly move on to the conservative balance just to see the nuanced difference in this compared to the conservative option on its own. When we go down to the allocations, you can see they do open it a bit to the more risky asset classes. So instead of having 70% in cash and fixed interest, they've now got 50%. Instead of, I think it was 11% of Australian shares, they've now got 22%. And so on. And you see this won't change much because still within those asset classes, it's the companies themselves don't change, it's just the amount of money that you have will increase. So to give you an idea of how these percentages actually worked, if you had $10,000 in your super fund and you were to choose this conservative balanced portfolio, that would mean that 50% of that $10,000, $5,000 would go into fixed interest and cash, or cash and fixed interest, and so on for the rest of the asset classes. Now, if we have a look at the balanced option, you can see moving into the higher risk level here. Again, they've got their performance and how it compares to the super ratings medium performance, and then their breakdown. So you can see here, they've upped the amount of Australian shares they have to 33%, which is now the biggest holding of this asset allocation. The next one is cash and fixed interest at 30%. Then you've got international shares at 27%, property, and then infrastructure and private equity. And again, you can actually see within the Australian shares and the international shares asset classes, it still is in descending order. However, you may notice from the last one, the order is different. So now as international shares, their biggest holding is in Apple, followed by Microsoft and then JP Morgan. And the same for the Australian shares. It's no longer ASX as the biggest holding, but the Transurban Group as the biggest holding. Now then, if we have a look at the growth option here, you can see again a higher risk level, but the annualized performance is starting to increase. Then if we go down to their allocations, you can see again, there's a change up in the percentage. They're moving more towards the shares and less towards cash and fixed interest. So they're moving more towards the riskier investments, the ones that have more volatility, and moving further away from cash and fixed interest. And again, there's a slight change up of the holdings and which ones they own the most of in this option as well. Now, just quickly through the rest of them, go on to high growth. Again, much higher annualized returns. And when we move on to the asset allocation, you can see almost the entire portfolio is made up of Australian shares and international shares. So very heavily weighted towards those particular assets. These do still have small amounts of property and infrastructure and private equity, but cash and fixed interest is completely gone. And then you've got the major holdings again. And then when we look at sustainable high growth, it is just entirely shares, Australian and international, Australian making up 55%, whereas the international 45%. And so in this one, because it's all shares, they give you a breakdown of the different locations in which the shares come from. And then again, you've got a list of the holdings and the order in which you hold them. And then for sustainable balanced, you can see the annualized returns there, the asset allocation. So with this compared to the balance, they've gotten rid of the infrastructure and private equity and property and just upped the portions of shares and cash and fixed interest. And then here is the descending order of the shares that they own, as well as actually giving more detail as to the fixed interest options. Now, keeping those pre-mixed options in mind, UniSuper actually offer one step deeper. So when you go to the sector section, they actually break down each of the sectors that they invest in themselves, and you can look at them with a closer eye to figure out exactly what's going on there. And if you're particularly bullish about one of these options, you can actually choose to create your own mixture of investments. So for example, you could elect to, instead of choosing one of the pre-mixed options, just have your entire portfolio invested in this international shares sector. But let's say, for example, that you actually wanted to do a mixture. Say you did like international shares, but you were also particularly bullish towards listed property. So you go down, you have a look, make sure you're happy with their, past performance, their allocations, and you could elect to do 50% in international shares and then 50% in listed property, or 75% in international shares, 25% in listed property. You can make up the split that works best for you. Now, one other thing that really helps put into perspective the difference in these investment options is using an investment performance comparison tool. Now, fortunately, UniSuper have one on their website. So if you go here, back to the investments page, but instead of the options, you click on investment performance, you can scroll down and get a graph view of the different options that are available. So you can see here, they've got the balanced automatically selected. As for most super funds, balanced is the option that you're automatically invested in if you don't select otherwise. So if we would like to compare that with conservative, you can see here they give you the two options, and this is what I was talking about. You can see here that over the financial year, the balanced option, although it's supposed to be not quite as risky as the growth option, has quite a lot more volatility than the conservative option. As you can see, although it goes up at a very flat pace. Then if we were to include the growth and say high growth as well, it really puts things into perspective. So you can see, obviously the peaks and troughs are similar amongst these three because they do all offer similar asset classes. However, it's just the percentage of each that varies. So you can see how they compare over different date ranges as well. So if we were to have a look at the last 3 years, for example, now you can also include specific sectors in this comparison as well. So if we take out growth and conservative and were to just put in international shares, for example, and listed property, you can see how those things vary. So you can see the listed property is the orange one up here. And then obviously took a big dip and didn't recover as strong as the other three. So this is also a handy tool to have a look at if your super fund offers it. Now, the one other thing I wanted to touch on is the fees that you have to pay for each investment option. Now, if you go to the product disclosure statements for your super fund and look at the fees and costs, you'll see there are some things like administration costs that are fixed fees that stay in place regardless of which investment you choose. However, as it sort of indicates here, there are investment fees and costs as well. So in the PDS, you'll see that they've got the balanced investment option at 0.4% per year. That's the fee you pay for the investment option. So one thing to keep in mind is that this is only for the balanced option. So if you were to change your investments or be invested in a mixture of sectors, the investment fee that you pay may be completely different. So if we go back to the investment options here and we click on whichever option we're considering, you can see just at the top here, they give an indication as to what the fees and costs are for that specific option. Then if we were to go to the growth option, for example, you can see that the fees for this one jump to 0.6%. And then for high growth, you've got 0.62%. So as you can see, for the pre-mixed options, it isn't too difficult to figure out how much the investment fees and costs are. However, at UniSuper and potentially for other super funds that offer a similar sort of sector by sector investment option, calculating the fees can be slightly more difficult. Now, if you were to just choose one of these sectors and have 100% of your super balance invested in it, then it wouldn't be too difficult. So for example, if you wanted to have 100% of your super invested into international shares, then yes, the total fee and costs for that particular option would be 0.62%. However, if you were to do 50% in international shares and then 50% in listed property, as we said before with the other example, then the total fee would actually be a bit different, because technically you'd be paying 0.6% on only half of your super balance. The other half would have fees of only 0.26%. So to figure out what that would be in total, it would be 0.5 to depict 50%, multiplied by 0.62%, which is their fee. And then all we need to do is add 0.5 multiplied by the fee of listed property, which is 0.26. And that brings the total fees and costs for a super investment that was 50% into international shares and 50% into listed property to 0.44% in total. So with all of the fees and the risk and the return all taken into account, there actually is one other thing that trumps all of those in being the biggest factor contributing towards someone retiring with a lot of money in super. And who would have guessed it? It's just putting money in. Now, as you know, it's compulsory for your employer at the moment to be putting 9.5% of everything you make into super. And although that percentage is scheduled to increase in the next few years, it might not be the worst idea to at least think about contributing a little bit extra as you go along. So hopefully that's given you a few things to think about. If you're with UniSuper, you'll now know a lot about their particular options. But if you're not, you should have the tools to assess your own super funds options to hopefully figure out which one works best for you. Now, assuming you've made the decision that you would like to change, how do you do that? Well, for UniSuper, you'd start by logging into your online portal. You then go to the menu and then select investments. And you can see here, there's an option to change your investments. Now you'll go down, make sure that you have a look at any disclaimers they have. Now, one thing to keep in mind, this is definitely the case for UniSuper, but it may be different for your superannuation fund. When you are switching, for the first switch in each financial year, you don't have to pay anything. However, if you do a switch later on in that same financial year, then you actually incur a $9.85 switching fee. So that's just something to consider. And after that, it's pretty much just going through. As you can see, it takes 3 to 5 minutes to complete. Now, if your super fund doesn't offer the functionality like this, you may have to complete a form, or you may be able to give your super fund a call and do it over the phone. Now, one other thing that I'd like to flag is that changing your super can impact your retirement. So before you make any decisions about swapping out of a particular option, I would highly recommend going and getting some financial advice. Now, your super fund may actually offer this as part of their service. So make sure before you go paying for a financial advisor's help that you check with your super fund, because you may be able to get some free advice there. Otherwise, just be sure that you understand the investments that you're going into and that you understand the risks associated with any of the investment options. But that's pretty much it for this video. Like I said in the last super video, there is so much content to go over when it comes to superannuation. So there are likely things that I didn't quite dive into deep enough and things that we didn't even touch on. So if you had any questions, just pop them down in the comment section below. Alan and I get to every single comment, so we'll try our best to assist. And if you have any other video recommendations, put them down in the comments as well. Now, if you enjoyed today's content and would like to see more of it, please consider going down, hitting the subscribe button and the notification bell. That'll just make sure that you're first to know when any new videos are posted. But if you can't wait for that, here's a video that YouTube thinks you'll enjoy, and this is our latest video. So hopefully one of those appeal to you, but if not, we'll see you in the next one.